Hey everyone, welcome back to Corporate Dakota, the place where we unravel the secrets hidden within the world of business filings. Today we're diving deep into Duluth Holdings Incorporated's latest quarterly report. Think of it as a financial checkup for the company that brings us those rugged Duluth trading workwear and apparel essentials. Now you might be wondering what is inside this document that tells us so much about Duluth Holdings Incorporated's recent performance. It is essentially a report card for the 3 months ending the 2nd of November 2025. It lays out their financial health not just for that short period, but also a look at the first 9 months of their fiscal year. We're going to sift through the key numbers to see how they're doing, how their strategies are playing out, and what it all means for their future. If you appreciate getting straight insights from corporate documents, make sure you are subscribed. We also have a Discord community linked in the description below, so check that out to connect with other finance enthusiasts. Let's start with a snapshot of what Duluth Holdings owns and owes. Looking at their balance sheet on the 2nd of November 2025, we see total assets of about $468 million. On the flip side, their total liabilities are around $310 million. This means they have more assets than liabilities, which is generally a good sign for financial stability. One of the biggest numbers on the asset side is their inventory standing at over $192 million. This is a significant amount and it tells us they have a lot of product ready to sell. They also have reserves for anticipated losses, which is a normal part of managing inventory, but it is worth noting the reserve has more than doubled compared to February. On the liabilities side, their line of credit shows a balance of over $44 million. This means they have borrowed money to fund their operations and inventory needs. This is a common practice for retail companies, especially those with seasonal sales patterns. Now let's look at how Duluth has performed in terms of sales and profits. For the 3 months ending the 2nd of November 2025, net sales were just under $115 million. That is a decrease of about 9.6% compared to the same period last year. For the first 9 months of the year, net sales were around $349 million, also down about 9.4% from the previous year. This suggests they are facing some headwinds in getting customers to buy their products. Interestingly, for the 3-month period, there was no restructuring expense. However, in the previous year's same quarter, they had a significant restructuring expense of over $6 million. This kind of expense can make profit comparisons look a bit bumpy from one period to the next. Despite the drop in sales, their gross profit, which is what is left after accounting for the direct costs of selling their goods, actually improved as a percentage of sales. It went from 52.3% last year to 53.8% this year. This means they are becoming more efficient in the cost of their goods sold, or perhaps selling at a higher average price. Their selling, general and administrative expenses, which cover things like marketing staff salaries and store costs, also decreased significantly, falling by $11.6 million for the 3-month period. This shows a move towards cost control, which is often a response to lower sales. With lower sales and some costs increasing or remaining sticky, the company reported a net loss. For the 3 months ending the 2nd of November 2025, the net loss was about $10.1 million. While that is a loss, it is actually a significant improvement from the net loss of over $28 million reported in the same period last year. So while they are still losing money, they are losing less money, which is a positive step. Looking at the 9-month period, the story is similar. A net loss of about $24 million this year compared to a larger net loss of over $38 million last year. The trend of losing less money seems to be consistent across the longer period too. Now let's talk about EBITDA and adjusted EBITDA. These are ways companies try to show their core operating performance by removing the impact of things like interest, taxes, and depreciation. Their adjusted EBITDA for the 3 months was a negative $738,000, which is an improvement from a negative $6.2 million last year. This is a good sign. For the 9-month period, adjusted EBITDA was positive at $7.5 million compared to $6.1 million last year. This shows their core operations are becoming more profitable, even as overall sales are down. It hints that perhaps their cost-cutting measures are starting to pay off. This decrease in net sales is a key challenge for Duluth Holdings. It appears to be driven by reduced promotional activity impacting web traffic. This could be a deliberate strategy to improve margins, as we saw with gross profit, but it is a balancing act. If they cut promotions too much, they might alienate customers or lose ground to competitors who are running more aggressive sales. Their balance sheet shows they have about $8.2 million in cash and cash equivalents. Looking ahead, they expect to spend around $17 million on capital expenditures this fiscal year. This includes investments in new stores and technology, which is necessary for growth, but it also means they will likely continue to rely on their credit facility to manage their cash flow, especially given the seasonality of their business. The company has been actively managing its debt. They have a revolving credit facility that was amended several times. times. Most recently, in October 2025, there was an amendment to temporarily increase their borrowing capacity. This flexibility is important for managing inventory builds. They've also recently entered into a new credit agreement that provides them with access to funds until April 2030, which is a positive for their long-term liquidity. A more complex part of their financial structure involves a variable interest entity called Tri Holdings, LLC. The company consolidates Tri because it is deemed the primary beneficiary of its operations, which mainly involves real estate. This means Tri's assets and liabilities are included in Duluth's financial statements. It is a common accounting nuance, but it is important to understand that not all assets and liabilities directly belong to Duluth Holdings Incorporated itself. Looking back at the previous year, the company had a significant restructuring expense. This was mainly due to a lease amendment for a fulfillment center, which accelerated the lease expiration and incurred termination penalties. This kind of expense can skew year-over-year comparisons, but the company has moved past that significant one-time charge. One interesting detail is their investment in an available-for-sale security, which is valued using level 3 inputs. This means its fair value is based on unobservable inputs and significant judgment. While not a huge part of their assets, it highlights that not all financial reporting is based on easily observable market prices. So what is the big picture here for Duluth Holdings Incorporated? On one hand, they are showing improved profitability at the adjusted EBITDA level and better gross margins, which are signs of good operational management. They are also managing their debt effectively and have secured longer-term credit. However, the decline in net sales is a significant concern. It suggests that their current strategies around reduced promotions might be impacting top-line growth. They are facing a competitive retail environment and economic uncertainties like inflation and tariffs. The company's direction seems to be focused on efficiency and margin improvement. The question is whether they can reignite sales growth without sacrificing those hard-won margin gains. The biggest risk they face is continued sales decline, especially if economic conditions worsen or competition intensifies. An opportunity lies in finding that sweet spot between promotional activity and margin control to drive both top and bottom line growth. My overall take is that Duluth Holdings is navigating a difficult economic climate with a focus on profitability through cost control. They've shown resilience in improving their core operating performance. The sustained sales growth will be the key to watch in future reports. Alright, that is our breakdown of Duluth Holdings' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.